Welcome back to another episode of the Sell Like a Leader podcast, the podcast for revenue leaders who are on a mission to cultivate a high-performing sales team within their organization. I'm your host, David Kreiger, president of Sales Roads, America's most trusted sales outsourcing and appointment setting firm. Today, I am super excited to have an amazing revenue leader. I'm sure you all know him, Mark Roberge. Mark is the co-founder and managing partner of Stage 2 Capital, the first venture-backed fund by over 1,000 top sales and marketing executives. He is the founding CRO of HubSpot, where he scaled the company from zero revenue to a successful IPO. And he is now a senior lecturer at HBS, Harvard Business School, where he spent over a decade teaching sales, marketing, and entrepreneurship. Mark is the best-selling author of the Sales Acceleration Formula, which I am sure most of you read. I use many of its principles in building sales roads myself. And today we are going to dive into his newest book, The Science of Scaling, which lays out a data-driven framework for founders and executives on when and how fast to scale. And all the proceeds from this book are donated to mental health research at McLean Hospital. And before we get started, I know my intro has already been long enough, but we have a quick gift for our listeners. We will be giving away 15 copies of Mark's book. So if you would like one, just direct message me on LinkedIn, and the first 15 people to reach out, we will send the book over to you. Mark, welcome to the show.
Wow, David. Thank you times two. That's a beautiful intro. I appreciate that. And again, thank you for the support on the book and the cause.
No, it's an amazing book, a really important cause. Excited to do it. So let's dive into some of the meat of the book. And so basically, I think the framework that you argue is that true scaling happens in three sequential steps: product market fit, go-to-market fit, and growth and moat. And so let's go through each one by one here. So I think most people do think they understand product market fit, but you argue that you don't think most have a clear definition of what product market fit is. And I think you even asked some of your students at HBS to define it, and they have trouble doing it. So I'd like to dive into how you would define product market fit, and what are some of the common mistakes you see founders make when they're trying to determine whether they actually have product market fit.
Absolutely. Yeah. And I'll kind of provide some overarching context around it, David, and then get precisely to your question here. So yeah, this particular work, I never really intend to go like write a book. It's just that I am very involved in the startup ecosystem from many dimensions. Most of my work these days is at a venture capital firm, so as a VC. So I'll probably look at like 1,000 startups a quarter. And so I just get to see the pattern recognition and what's happening. I'm involved in about 75 board meetings a quarter. So you get to kind of see what's happening in the founder mindset and these sales leaders' mindset. And then I'm also blessed to be invited to go speak about these things, whether it's at South by Southwest or SaaStr or Inbound or whatever. And so like every year I'll do like 2 or 3 fresh perspectives on what's happening, and then would repeat it across various venues. So I've done like 40 or 50 of those fresh perspectives over the last decade. This particular one, The Science of Scaling, was first spoken about at the 2019 SaaStr conference. And it just went viral. I think it was like one of the most watched videos for many years at from SaaStr's speeches, which is just a signal, right? That, you kind of stumble across something that is timeless and abstract. And I just kept writing about it. We did a bunch of classes and cases about it at HBS. It's taught a lot of different business schools. People kept asking me to talk about it. And then eventually it was like, can you write this up? And so that's how this work came about, just so people know it's not like something I thought about last month and just like, this is just like in a natural progression. And it's just, it's crazy how much unnecessarily failure occurs in any business because of a lack of rigor on these 2 critical questions, David, of when to scale and how fast, and how little rigor is. It's crazy how many classes there are in college. When you remember your Wharton days, David, like on accruing and recognizing revenue, really detailed frameworks and formulas, no questions about what net income is. And like the same set of rigor doesn't exist in when to scale and how fast. And it's just a massive hole in our business community and our startup ecosystem. Okay, so that's the framing there. I would say, like, if we tackle the first question, like, when are you ready to scale? I think a good answer is product market fit, and we hear it quite a bit, to your point, David. Thank you, Eric Ries and the Lean Startup. Thank you, Steve Blank, and his work at the beginning of the century that led to product market fit and evolved our startup ecosystem for the better forever. We no longer built products in a basement and then tried to sell them. We built them hand in hand with customers. Beautiful. And I think this work, product market fit, came out of it. But to your observation, David, when I go, and I've done this at every single speech this year, where it's like, okay, product market fit. And I went out into the audience and I had one person on the right side of the audience whisper to me what product market fit is. And I went to the left side of the audience and I had them whisper to me what product market fit is. No one has ever matched. Now, if I did that for net income, they probably would match, right? And so the most common answers I get are something like 100,000 in revenue or 100 customers or 100 inbound leads a month. Those are when I have product market fit. And you can define it however you want. I would argue with high conviction that those are wrong and wrong. Because then my second question would be like, okay, fine, I'll give you all three. I'll give you 100,000 in revenue. I'll give you 100 customers. I'll give you 100 inbound leads a month. What happens if you have all that and half the customers are churning and stop using the product? And then, do your product market fit? And the CEO will be like, no, but I will just listen to what the issue is and adapt the product to address their issues. And I'll be like, how do you know when you've done it? And he or she would be like, when they stop churning. I'll be like, exactly. So that's like kind of a moment for them, is like, product market fit is not about whether your thing is selling. That's market message fit. Those are infomercials. Product market fit qualitatively is when your product delivers the value that you promise to the market and is best quantified by retention.
And so I think it's a beautiful framing. And I think the pushback, which you address in your book, is, well, Mark, that's great, but it takes a year, if we've got them on a contract, to know whether they're going to churn or not. And I've got investors that need me to scale. They need me to move on. So the metric that's much easier to quantify is those three that you talked about. So how do startup founders who say, listen, I love what you're saying, Mark, makes a lot of sense, but I can't wait a year to figure out whether I've got good retention or not?
Yeah, you can't sit here and be like, okay, we did all the things the lean startup said. We have this hypothesis around a problem we're solving. We got 4 design partners. They love the product. And now, according to Mark, like, we have to define product market fit as retention. Now we sign up 10 customers. I can't wait a year. So that's where we have to define our leading indicator of retention. And this has definitely been a favorite part for the ecosystem in the work. And so, to David's point, like, the lead indicator of retention is something that we can observe usually in the first month of a customer's experience with us, our business, our service, our product, whatever, that if that occurs, they'll be with us forever and renew it forever. And if it doesn't, they will likely churn. And this is one of those cool things where there's not a universal definition. It's not like they use it every day or like they whatever. It's a cool, like, entrepreneurial moment of creativity where we can think about what it should be for our business. Now, I will scaffold it a bit with a framework, a formula of P% of customers do E-event every T time. Okay, so now this design decision is framed down to 3 variables, P, E, and T. Okay, and so let's use a couple fairly well-documented examples from practice. Let's start with Slack. So many people use Slack. So Slacks would be 80% of customers send 2,000 team messages every month. This is beautiful. Imagine if Stuart acted like most founders and was like, hey, we got our product working. We have 4 design partners. Our next North Star metric is to get to $1 million in revenue. You can imagine all the things that happen. Hiring a ton of salespeople, spend a lot on marketing, raise a ton of VC, whatever. And versus if he stood up and was like, our next North Star metric is to have 80% of our customers send 2,000 team messages every month. Such a better routing. Okay. Now, as I say that, I just want to clarify for everyone, this is not about going slow. This is about going as fast as possible at the right metric at the right time. I find that most founders I meet half of them are going too fast too early, and half of them are going too slow and too late and going to miss the window. And this is around tuning it to your business context and the underlying performance of the business. Okay. So that's the LIR, the lead indicator retention is P% of customers do event every T time.
So now I'm gonna thinking like some of the founders and challenging this and where they struggle is okay. So I'm going after these metrics, but the problem is I've got a few salespeople who are trying to close the deals, and then I've got some individuals who are doing customer success and trying to get them after these metrics, and they're blaming each other for we're not doing this. So I think you come up or you talk about an interesting way to make the first sales hire, or in this regard, to try to make sure that you're going after the right metrics. And so, could you walk us through that?
Yeah, aligning these things is really critical. So let's stay with the Slack example, and we're saying, okay, our first North Star metric is to get 80% of our customers to send 2,000 team messages every month. Lots of times you'll end up with a salesperson in charge of acquiring the revenue and a customer success person in charge of making them successful. And I have to parachute into a lot of companies where that churn becomes a problem. And the first place the board usually looks to blame is the customer success team and the rigor of the onboarding. The second place they look to blame is the product team and the rigor of the product. They don't often think about the sales team, and that usually is the root cause of the churn. If you have 50% churn, that's really bad, but it also means 50% of your customers are actually working. And if you just changed and acquired in the same way with the same expectations, the good 50%, you will have a massive retention success, right? And so most of these deficiencies on retention and the lead indicator retention is caused by who the salesperson chooses to sell and the expectations they set. And so at scale, one of the underutilized but very successful compensation plan to align this is to pay the salesperson half of their commission when the customer signs the contract and wires the money, and half of the commission when the customer achieves the lead indicator of retention. And so in Slack's case, it would be like you get half of it when they wire the money and half of it when they send 2,000 team messages in their first month. And you're like, your first thing is, I don't want to turn my salesperson into a CSM. You're not. The CSM's still there. They're still doing their job. It's just that the salesperson is going to set the expectation and talk to the people necessary to make sure that LIR comes to life, right? Like a common thing is salespeople don't need to talk to IT to get a contract signed. But if you don't get IT on board, if there's any setup necessary, the CSM is screwed, right? And so that's just an example of like, they're going to talk to IT if they're compensated accordingly. And you'll often find in this case that like in Slack, like you can try the product for free. The salespeople will get the customer to send 2,000 team messages a month before they even sign the contract. What better way to like align these things, right? And then just to like click one more time on your question, David, in the early going, sometimes you don't have a CSM and an AE, and you're just dealing with your first go-to-market hire. And it's kind of advantageous. It's advantageous to have someone that's full cycle, that's doing both sides, at least in the early goings, to eliminate this misalignment.
Yeah, and so let's talk about that person, because I think that's a step that either startups stumble into and they get lucky because they got the right person willing to do it, or they do what you're saying where they build this, they get a little bit of a green light on their what they think is product market fit. They hire the big sales team, they have a whole customer success team. So if they are it's a better path to find those who you call process builders. Can we talk a little bit about, you know, how have you seen the best companies identify who those people are? How do you hire them? And what really is their role within the organization that creates some magic there?
Let's frame out that whole question, because so far I think what we've established is we've started the conversation around when are you ready to scale? And we've taken away that product market fit is a good answer. It just needs to be defined well. And it's best measured by retention and codified with the lead indicator of retention. That's our first goal. And we're going to define that for our business and go at it. And then David alluded earlier that you're not ready to scale when you have that. You have to do the second step, which is go to market fit. Because all you've proven at the product market fit phase is that when you go out and acquire another 10 customers this month, the majority of them will see value in your product. You haven't proven that you can acquire and onboard, serve those customers profitably, nor should you. In the first phase of the business, like the famous Paul Graham, founder of Y Combinator, says, do unscalable things early. And that's what he means here. Is like, it's even Elon doesn't get it right every time. Like, it's very hard to invent a product that delivers the value that you intended as an inventor. And so you need to focus all of your energy in the first phase of the business on helping customers see that value. Even if it means flying to their office to onboard them when they're paying you $50 a month, do it. But once we've achieved that, we're not ready to scale because we need to prove that we can, that's not scalable. We need to prove that we can acquire those customers and serve them. And that's what we call go-to-market fit. And once you have go-to-market fit, then we move into growth and moat. Now, it turns out that as you navigate those different phases of preparing for scale and entering the scale mode, the decisions on your go-to-market system design change. The way you sell, the way you generate demand, the way you price your product, the way you define your ICP, the way you hire your team, which is what David's asking about. The optimal hire at the growth phase is very different than the optimal hire at the pursuit of product market fit phase, as well as the pursuit of go-to-market fit. The number one salesperson at Workday is a terrible first hire for you. It's a really good growth hire, depending on your context, but it's a terrible first hire because the number one salesperson at Workday is number one because they came into the Workday office, they went through the 30-day training, they went through all the commission planning and the pitch decks and the sales playbook, and their manager helped them, and they had all the Gone recordings coaching them, and they were given a territory and a commission, and they went out and cranked. You don't have any of that. You don't even know who you should be selling to in the product market fit phase. So you need someone that's almost like half product manager that can see patterns and communicate with engineers to accelerate your learning, and half account executive that's comfortable talking about money and commercials and understands how to run discovery processes, right? So that's our ideal first hire. And then to David's point, as we achieve product market fit, and now we're in go-to-market fit, we need someone that can build that process. And so like, where do you find these people? In the product market fit phase, usually a place to find the person is pick your favorite Series B through Series D funded business that has a similar go-to-market motion and find the first reps because they are miserable right now. Like they were there when there were 6 people in the room. They were sitting with the founders. It was so fun. Now they're in the factory. They have a manager and a comp plan. They miss the old days. And some of them are meant to be career first go-to-market people. That's their purpose in the ecosystem, which is great. So that's a good place to find that product market fit person. And then the other, once you move into the go-to-market fit phase and you need a process builder, usually it's someone that was like recently promoted to management, say in the last 6 to 12 months at again, like probably a Series B through Series E company. Because what happened there was they're not far enough away from carrying a quota that they forgot how to do it because they're going to have to do some belly-to-belly stuff. But they've had a taste of the systematization, the management, and the process development.
That's a great way of redefining the first 2 stages, which I think a lot of people think they know, but they don't realize, and most get it wrong. And so I'd love to move to the third phase, which I think people, at least with the words, they might think that they understand it, but I think it's a really important phase that you've defined in the book, which is growth and moat. And so first, can you define that stage for our listeners?
So now it's like, okay, we have product market fit and we have go-to-market fit. And we've calculated them using our own data. And we've calibrated them for the context of our business. In some cases, we're under a lot of pressure to blitzscale because of a category. So we've set those numbers accordingly because we got to go fast. Half the entrepreneurs go too slow. So we've done that. Now it's like, how fast should we go? We're ready to scale. And the first pothole is easy to fix and very intuitive when you think about it. Because usually what happens is it's okay, cool. We have product market fit. We have go-to-market fit. Let's go raise a round of funding, or let's go sign up to the board of what this year is going to look like. And let's go from 3 million to 12 million. And so they sell that to the next round investors. They get a good valuation, or they sell it to the board, and they're like, okay, cool. That means we need to add 9 million in revenue. Each rep does 800,000 in ARR. And so I just do the math. I need 12 reps, and they hire 12 reps next week. And that's the scale process. And that is ridiculously broken and causes a ton of unnecessary failure, because there's absolutely no awareness or consideration on the operational flywheels that are necessary to build to hire 12 reps successfully. Let's just start on the recruiting front. You could probably argue that the more qualified first interviews you do to the hire is going to yield better quality hires. If you do 2 high quality interviews and hire 1 person, you're probably going to make a worse hire than if you did 10 high quality interviews and hire 1 person. So if we're trying to do a 10 qualified phone interview screens to 1 hire, and we're going to make 12 hires, we need 120 good qualified resume and first screens. Who's doing that? Who's doing the interviews? And then who's ramping the rep? And how are we 12x in demand gen overnight? There's these operational flywheels. So the fix to that is easy. You don't think about scale at this moment as a lump sum hiring right after a fundraise, or lump sum hiring right at the beginning of a fiscal year. Scale is about establishing a pace. It's not let's hire 12 reps and see how 2026 goes. It's let's hire 3 reps every other month. Okay, so now we do that, and that allows us to build these operational flywheels. Okay, and it also allows, and we're going to do that forever. You're always going to be hiring if you're scaling through that way. If you're B2C, then, and I know most folks here are B2B, so if you're B2C, it's more like just investing in marketing. So you're just going to scale that forever, and you're going to throttle the pacing up and down depending on the signals of the business, right? So this measure of product market fit and measure of go-to-market fit now become our speedometer and telling us if we're going too fast or too slow. So now we're going to hire 3 reps every other month for 2 quarters, and we're going to watch these indicators. And if they go red, we're going to intervene immediately and fix them, hopefully within a week, and get it back on track. But if they stay green, we can throttle up and go to 4 reps every other month for 6 months, and then throttle up 8 reps every other month for 6 months. And now you've become a unicorn in a very calculated way, along the way monitoring. Because most people will monitor whether they're going too fast or too slow at the board meeting results of churn, which is 6 weeks after the numbers were put in. And the churn is a result of the work you were doing a year ago. So when you operationalize the business with these frameworks, you're running your business usually about 5 quarters ahead of your competitor.
Yeah, and I think you bring up a good point about the recruiting side, but also when you're doing that and you're recruiting and hiring 10 people, I think people so underestimate, especially for a new product and for a company that hasn't created a whole training program, but the training and coaching side, to bring 10 people on and you probably don't have that infrastructure. It's really hard to coach and train 10 people all at once. And so right there, you can create a nightmare where you can even bring in some of the right reps, but you're not giving them the right type of support to be successful. And so I think another part of this is that you talk about in the book is pricing and competitive positioning at this stage. So can you talk a little bit about where founders go wrong in that regard, and how does that play into this phase?
Yeah. Pricing is another aspect of the go-to-market system, and it does need to adapt through each phase. In the pursuit of product market fit, it's rare that pricing is that important. The only time it's absolutely mission critical is if the entire innovation of the business is a pricing innovation, which is rare. Sometimes it happens, but like usually your main innovation is some sort of new value creation for the customer that's not associated with the price. And so my guidance at the pursuit of product market fit is price for commitment, not profitability. So we don't want price to be a friction point toward achieving our lead indicator retention and product market fit. So at the same time, I don't want to just be giving stuff away for free, because I want the customer to be committed. Okay. So usually what we'll do at this point is we're trying to find our first 5 design customers, and we'll say things like, we'll be doing great discovery. We're working on this problem. Can you tell me about how you're thinking about this problem? And then we'll navigate to like, you know what? You're like the 19th head of RevOps that I've spoken to, and all of your peers are saying the same thing, exactly how you just framed it. In fact, we are building what you just said. and it's coming out in August. And we'll be charging $50,000 a year for it, but we're just looking for our first 4 design partners to use it. And in exchange, we'll be giving them a 90% discount for the first year. So would you like to sign a letter of intent today with a $1,000 deposit to be one of those 4 design partners and have a 90% discount on the product for the first year? I think that's beautiful. First off, just asking that eliminates so much false positive of like people like, oh, that's, if you build that, I'll definitely buy that. Like, all right, do it, buy it right now. Prove it to me. And if they're not going to sign the LOI, now I can, as you know very well, David, like that's when the real objections come out and I can get at them. And now I have my 4 design partners and I picked early adopters who are going to be good design partners for me. Now, when we move to the go-to-market fit phase, we're trying to prove that we can acquire and serve those customers profitably. So price becomes crucial to get right. And usually like a simple dimension on price design there is 3 lenses. The first lens is, what does the price need to be for your unit economics to work? What do you predict is the acquisition cost, and where's the price need to be for you to have a business? The second lens is, how does the customer think about ROI? So if you set a price here, do they see this as a very strong ROI purchase? And the third lens is, what is the substitute price? How much would it cost them to solve the same problem in a different way by, say, hiring a different consultant or buying a different set of products, whatever? So that usually gets you pretty close to an optimal price. And then as you move to the growth and moat phase, price can be a proponent and detriment to your moat. And people don't really, especially this day and age in AI, the moats are very weak. And oftentimes when we're making investments and we ask founders, what is your moat? They talk about a feature. And then my follow-up question is, let's say you're right and that feature kills it and you win all the customers in the next 3 months. Obviously your competition is going to find out and they're going to build the feature. So how long would it take them to build the feature? And if that answer is like less than 9 months, that's not a moat. So like that really is the answer that you need, is like, a good moat is if 5 awesome engineers from MIT or Stanford or whatever copied your product, how do you still win? And the higher you set the price, the more attractive a target you are for a copycat. We're seeing a lot of that right now. This is a very attractive moment for copycat entrepreneurs. The fast follower has usually won over the last few decades. Like Slack and Zoom and Salesforce were not the first versions of those categories. It's usually the fast follower that wins. And a lot of VCs and founders don't get that. They put a lot. There's definitely a first mover advantage, get the most money, get the best engineers, get the best logos, the whole blitzscaling mentality. It's definitely real, but it doesn't win most of the time. And the fast follower copycats win most of the time. And this is a moment for fast follower copycats because there's a big why now with AI, because copycatting is easy with the accelerated product development cycles. The first wave of AI companies have raised at such a high valuation. They're in what they call ACV jail. They can't lower their price because they're trying to grow into the valuation they promised. And then the third is they don't have much of a moat. You know what I mean? So yeah, it's a pretty interesting time for copycat technologists.
Yeah, and with that, because you can also have copycats of the copycats. And so it is an interesting time. All these AI. So moat can be pricing against the first movers, which is an interesting perspective. And I think people need to think about that as they're building their product. But what are the other moats? Because if you come in, you are just trying to create a moat around by undercutting price. You're going to get undercut too, because everyone can be an entrepreneur, as we all know now, and there's going to be so many people jumping in. So how does this not just become a vicious cycle or a great cycle for customers to the bottom?
Yeah, and this is all good. Like another, I think, important piece of the science of scaling timeless rigor is it creates first principles by which to build these new AI operating systems. And I think we're essentially replicating how it was done 3 years ago, but the real innovations happen when you pull all this stuff down to its studs and rethink it. And that's going to be the stuff. And this is kind of what you're getting at, David, on the moat front. Couple example moats. So on the thread that we were just pulling on the copycat, one of the most, I think a good moat will be how you run your business internally in an AI first way. And I think the companies that were started like 2, 3, 4 years ago as AI native companies built themselves too much like the SaaS businesses of 2015. And it was partially because of the lack of understanding of how all this stuff could be done. And we still don't even know. Like, we've had massive advancements in like product development, but we haven't seen the same advancements in sales yet. It's coming kind of this year. But for example, we're seeing a movement toward much more athletic full cycle roles where we are reversing the specialization trend that we saw in R&D and go-to-market. In 1985, we had one role engineer. In 1985, we had one role salesperson. And in 2010, R&D was like PMs and front-end engineers and back-end engineers and designers and data scientists and data analysts. And like, you're starting to see it go back where PMs are being asked to do more. And the same things happen in go-to-market, right? We used to have rep. Now we have SDR, AE, AM, CSM, RevOps, whatever. We're starting to go back. There's a cost. Specialization has advantages, but also has a cost, starting with a terrible experience for the buyer. And AI can elevate an individual human to do all the roles more than adequately. It is really hard for an established company to move to that, to retool their people, to restaff, to like, so if you can operate from the ground up in a very AI first efficient way and pass some of those efficiencies onto your customer, that will be a moat. And so like, there's just a lot of meat on the bone right now is like that copycat can come in and literally charge 70% off for the same product. The copycat of the copycat doesn't have as much meat on the bone. If the copycat does a good job and runs their internal org in a highly efficient way, maybe someone can come in and do 5 or 10% less, but it's just not going to move the needle. Okay, so that's just, I guess, just to zoom back, it's like one of your moats is how to operate your internal organization in building and distributing product in a highly AI first efficient way. That's a moat. Another moat is, I think I'm pretty bullish on vertical AI software in non-tech end markets. So that was a lot right there.
Yeah,
we felt like we were back at Wharton, David, right?
Yeah,
Like,
I know. That's
I was like, oh, welcome to class. We're going to talk about vertical AI software in non-technical end markets. Yeah, let me build that out a little bit. So vertical software has had a great decade. Toast and ServiceTitan, some of the best names. And Toast is restaurants, right? So even in that huge win, you go to your favorite restaurant that's running on Toast, they have other software. They use Toast for the POS. So a lot of the back office stuff, they use other things. They don't file their taxes with Toast. They don't some of them don't even pay their staff on Toast. You know what I mean? There's other tech. And in this next era of vertical AI, because R&D cycles are so rapid, you can imagine that the whole tech stack will be on one vendor. If you're a small manufacturing plant in Nebraska, if you're a regional bank in Minneapolis, if you're, we have a roofing company. And it turns out that like roofing has some very unique workflows. There's actually drone photos that occur, right? So like and that's a reason why ServiceTitan is not ideal for them. So there's this opportunity to pick these somewhat smaller markets that had historically been too small for a venture capital outcome that are now very attractive because the ACV potential is 4x because you're going to be the entire tech stack. And when you have the full, if you're like, say, in roofing, and you built the full operating system where all this stuff talks to each other, you can call it whatever you want. It's a brand moat, it's a trust moat, whatever. These roofers talk to each other. And if everyone trusts Mike's roofing company and Mike is using your vendor, they don't really care who's cheaper or who has what feature. They just care that is working for the best in the industry and it's going to work for them. And so there's a bit of it's Michael Porter's like barriers to entry brand moat from 1970s is one way to call it. I think a lot of folks around the ecosystem are calling it a trust moat right now.
All right, a lot to unpack here. I want to start with the first org chart mode, and really the argument is around being able to either build your company from the ground up as an AI first, or do like what Jack Dorsey's trying to do at Box and just try to re-engineer, and I guess a few other companies are to be an AI first. So first, let's talk about from your point of view, because I think a lot of people are trying to understand this, think about this, figure out what this actually means.
Yeah, I want you thinking about this too. You've always been a thought leader on this stuff, and I'd love to hear your takes. And I have a lot of conviction on this because, like, I've been sitting in these board meetings and all of Q4 and all of Q1, it was like I'd show up and, oh, we are so AI native in our sales team. And I'm like, really? What? Like, why? You're writing emails with like ChatGPT? Like, how do you know? So that's really what I've been pushing everyone on is, can we measure this? Okay, so this is a cool thought process. So let's just focus on go-to-market and how do we know if we're AI native and what's the opportunity? Okay, so the end goal is productivity per rep, let's say. Okay, so you got Bob and Susie who've been with us for 3 years, and every quarter they've closed $250K a business each within 5%. So we know that that's the bar. We are AI native if Bobby and Susie start closing 500K all of a sudden. Because like that's, and then we can argue LTV and all that kind of stuff, but like fine, productivity doubles, okay? Let's extract that one level back. So one first principles formula that's not talked about much is called the revenue velocity formula. And what that is, it's the number of active opportunities a rep is working times the close rate times the ACV divided by the sales cycle. They're actively running 20 opportunities. The historic close rate has been 10%, so they'll get 2 of them. For the ACV is 100,000, so that's $200,000, and the sales cycle is 2 quarters, so it's $100,000 per quarter. That's the revenue velocity formula, okay? That leads to PPR, right? So the question is, with those 4 variables, close rate, ACV, number of opportunities, and sales cycle, which one's easiest to double? Now, don't go after ACV, because if you double price, that's a whole different story. That might push you into a whole nother target market, whatever. You can't mess with that too much. Close rate and sales cycle are dependent on buyer processes. And buyers have not adapted with AI their buying processes as fast as sales has. You're dependent on the buyer. And that has become like a major bottleneck. Number of opportunities is completely in your control as a salesperson and as a sales team. That's the one that's the easiest to double. So that's our goal, is like we're going to double PPR by doubling the number of active sales opportunities in the revenue velocity formula. And so how can we double the number of active sales opportunities without compromising quality of our sales efforts? And the next pullback algebraically is selling time. So selling time is defined as the percentage of a week that a rep is in front of a customer. And over the last 2 decades, it's been best in class around 30%. With today's AI, that can be pushed to 60%. Okay, so now it's like, okay, measure selling time. You're not even measuring it. Every sales team measure selling time and now double it. And if you can double selling time and keep everything else constant, your rep will double PPR. And so that basically creates your roadmap for AI in sales. How are we going to double selling time? Let's automate the CRM updates. Let's automate meeting generation. Let's automate demo, wireframe, sales room creation. You get all the things that people are talking about, but let's frame them in this formula to measure if we're how sales AI native will be. And I think the top 5% teams in tech sales this year will get to a 60% selling time and will double PPR for their legacy reps.
And so with that, in the short term, it's a lot about using these tools efficiently, building them into your tech stack. And I think a lot of companies are trying to do that, and some are doing it, like you said, successful in getting to that 60% metric. And I love how you're framing it, as you always do, with a clear metric to go after. How do we move past that? And I think you talked about it, right? There are all these different roles that were actually created to try to increase selling time, right? The SDR role was created to increase selling time for the AE. But AI does give some opportunities to rethink the org chart now. And so if people start optimizing the tools, updating CRMs, with it being able to do their research more effectively, help them to do their follow up more thoughtfully and quicker, are there other aspects of how we rethink what has been the org chart over the last 15 years? And how does that align with the metric of increasing selling time?
Reverse the specialization curve, and the SDR, AE, AM collapse into one role. And it's like the AI should be good enough to get that one person to perform better. Because like, let's just like take that specialization decision, right? Like the advantage of having an SDR, AE, AM, and CSM is it allows us to put the right skill in the right role. when you're coming out of college, you don't go into like strategic accounts, you go into SDR, right? If you're more relationship oriented and technical, you might be a better AM, right? So like if you're really good at closing and discovery, we don't want to waste that skill on onboarding. We want you to be selling. Those are great. Now, the disadvantages are, number one, terrible buyer experience. I meet John, the SDR, and then I meet Mary, the AE, and now I'm passed off to Greg, it's terrible. And furthermore, the internal handoffs are so hard you end up with local maximums of SDR solve for meetings, AE solve for revenue, and CSM solve for LTV, and they're all messed up. And so today's AI causes the advantage of specialization to go away. And so if what you should do is, if you're scaling, keep running your legacy teams, keep running your SDR plus your AE plus your AM and see how that performs. Run a test team, 2 or 3 full cycle AEs in some territory, and just keep working on them with AI until they outperform the legacy model, and then phase out the legacy model.
I've been trying to think through this a lot because I think that AI obviously helps AEs do a lot of these tasks that they didn't have time for before in a much more efficient way. What I think companies are running up against, and I think maybe it's a legacy thing, maybe it's the number of salespeople who have this disposition, maybe it's who we're thinking of as who we should be hiring as salespeople, and maybe we have to rethink that a little bit. But it's still, I think companies, first of all, obviously struggle using these tools and figuring out ways to do it. We're going to get to a point where we figured it out and there's a roadmap and whatnot. But it's also the focus. And so the AE is now going to need to still, we need to push them. Prospecting is still a very difficult thing, even with the AI tools and things like that. We've got to push them to be able to do that. And there's some friction there. And then also customer success is a little bit of a different animal. And in some ways, you're needing to hire either for a different type of person who can really use these tools and these processes in a different way and be that super sales person. Um, and in some ways, I love the formula that you laid out. And I'm just curious, going back to some of your original metrics, if you just focus on selling time as the lever there, I think that there are some challenges, right? Because you're now taking on 3 roles. You've got all these other things you're still needing to do, even if you can do them more efficiently. With that formula, if you can factor in close rate, and I get it, there's buyers that's somewhat in the buyer's camp, but if you can factor in close rate, and then the magic number that we started the conversation with, which is retention, because the buyer journey, like you just said, is broken or is more challenged with this. But if you have one person doing the SDR role, doing the selling and doing the customer success, hopefully retention will go up. And so I'm wondering if there is a way to layer in some of those 2 other variables.
You're right. I got to think about that. Thank you for challenging me on it. Because it is so ironic. I was on the call I had before shooting this with you was with this guy, Fred Reicheld, who invented NPS. And like we had an awesome talk about this stuff. And now he's working on codifying referrals in the same way. And I think you're absolutely right, that's the downside of specialization is no SDR is going to book a crappy meeting if they have to sell it. And no salesperson is going to book a crappy customer if they have to deal with the customer post-sale. And that's this beautiful flywheel that you're servicing up, David. And I got to figure that out in the math. I think it's somewhat in the PPR, but if you measure productivity per rep in an LTV basis, it could account for that. And then you also have this viral coefficient referral thing, which is like, it's another one of those hidden gems is like how much money and time has been put into codifying outbound and not codifying referral generation. Imagine if like all the work at SalesLoft and Outreach had gone into similar systems to generate referrals. So that's a big opportunity for us, especially as we go to this full cycle role.
We could jam on this for a lot longer, Mark. This is such great stuff. I've got to move us to close, though, here. And so what I love to do is ask our guests a few rapid fire questions. And so mind if I shoot a few at you?
Yep, let's go.
All right. So what is one thing people don't give enough value or attention to in leadership?
Understanding the personal motivations around growth in career and even perhaps wealth. To sit down, that's the thing I love the most is once someone had been with me for 3 months and had like started drinking the Kool-Aid and kind of lost their memories of their last employer, just sit down and ask, what gets you up in the morning? What do you need money for? What do you need your career for? And the answers that come out of it. My most favorite one was a gentleman who had an autistic child that needed to get into private school and he couldn't afford it. And we rooted his sales call metrics with that goal in mind, and we got there.
I think it's such an important thing, and I haven't had anyone talk about it. And it's really the why behind, whatever we're doing in business school. One of the professors I had did have us ask, or he asked us, what job do you want to get out of this? And then we just would say it. And then he just asked us why, like
Yeah.
15 times.
Yeah, that's awesome.
And to get to the essence of it. So I love that.
That's awesome.
What is one skill you advise everyone in sales to master, leaders or non-leaders?
Consultative selling, good discovery. Walk into a wedding or a random room this weekend, walk up to a stranger and see how long you can ask them questions without them getting pissed off and feeling interrogated.
Love it. Favorite business leadership or sales book?
Qualified Sales Leader by my mentor, John McMahon.
Favorite quote, mantra, or saying that inspires you as a sales leader?
I think Ben Franklin said, when you're finished changing, you're finished.
Love that. And lastly, what's the most important goal or project you're working on right now?
Yeah, the book that you're contributing to and mental health. I think we've come a long way in fighting the stigma, but we still have work to do. When you find out that someone recovered from cancer 10 years ago and you're interviewing them, you probably elevate your perception of them. If you find out that they struggled with serious mental health 10 years ago, you might have concerns, which is not fair. They're both diseases, often genetic. And so these folks have to suffer in silence. I've been a direct caretaker. I've also been a patient, and not everyone can be that transparent because of the stigma. And so that's the big thing I'm working on now. I also think as a tech community, we're over-investing in building and profiting in AI and under-investing in helping society adapt. And we need to find ways to balance that a bit. This is my little way right now with this book and the donation, and I'll do more later. But I just hope everyone can find a little way to, and all the little ways add up.
I think that's beautiful, Mark. And I think we glorify both the tech leaders and their successes, but we don't think about some of the sacrifices that they're making to their sometimes mental well-being, unfortunately, and they feel that's what's expected of them in order to succeed. And so that is a real difficulty. So appreciate the work and how you're doing the support there. So thanks again, Mark. This was a fantastic conversation. Really appreciate your perspectives on this, always bringing such a rigorous thought process to things that people take for granted and don't feel like that they take them, maybe for lack of a better word, at face value. And you really unpack it in ways that I think challenge us all to think better and do our work better. So really appreciate all the work you've done on this and coming on the show to share your perspective. And so first of all, again, we're giving away 15 copies of Mark's book. So please hit me up on LinkedIn and we will ship that out to you. But Mark, if they want to learn more about the work you're doing, more about the book, how do they find it?
Yeah, I'm most active on LinkedIn. I'm trying to get TikTok going for the younger crew, so you can check me out there as funnier videos. But yeah, LinkedIn is where I put a lot of codifications, so check me out there. Thank you.
Thanks again, Mark, and appreciate everyone tuning in today. Until next episode, happy selling.